Markets around the world are looking rather weird. The big names are leading flows to the downside, while safe havens and high beta stocks are rallying. At the same time, yields are barely moving despite a strong bond auction. So in a market where nothing makes sense, what do we do? Today, we answer that question. You'll get the insights regarding where we are, where we've been, and where we're going. And we're also going to be talking earnings, seasonality, and of course, Bitcoin and how it can fit into your portfolio. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers. On a sector basis, pretty green day today. However, the big names, look at Apple, Microsoft, semiconductors, really led downside flows, and that weighed on the indices as a whole. We saw outperformance again in Google, getting a bit of life. Same here with PayPal. The market seemed to be appreciating some of the work that team is doing. But all in all, it was a very red day here for semiconductors, but a lot of green in a lot of other sectors. I mean, look at financials, extremely green, energy, basic materials, utilities as well. Healthcare was a bit mixed. Same with staples. These bigger names weighing on staples for the most part. And then Tesla down another 4%. I did say yesterday it was probably going to go lower, and this is exactly what we're seeing. I think we might even see Tesla like $130. But looking at sectors, I mean, GDX up another 2.43%, absolutely rallying today. We saw energy up 1.56%, materials, utilities, financials. So a lot of cyclicals, a lot of safe havens, a lot of defensives doing really well. We saw staples here as well. And then these sensitive names, semiconductors, technology, software, really taking it on the chin and weighing on the index. The SPY down 0.16%. But let's hop on the charts and I'll show you everything. Now guys, this is the S&P 500 weekly chart. But before we get into it, let's actually have a look at some of these indices. S&P 500 and the QQQ, the Nasdaq 100 down 0.2% and 0.83%. So large caps taking it on the chin, but the broader market held in there. Look at the RSP. Mid caps, small caps, and IWM, so like higher beta, were green for the day. So we're starting to see a broadening out, not just in sectors, right, but also in size of equity. What we did see was bonds were actually all down on the day, which means yields rose ever so slightly, but vastly inconsequential. And then we saw Bitcoin up 2.76%, gold up 0.76%, oil up 2.66%. Now looking at the S&P 500 daily chart, so zooming in, this price action right here, this red body daily candle tells us that, the market is just digesting yesterday's gains, digesting the CPI report. It was just a digestion day, and that's a really good thing. When we've run off pretty much from the bottom left of the screen to the top right, having a bit of digestion, a correction in time, maybe even in price, not necessarily a bad thing. If we go to the weekly chart, we could actually pull back to this level right here, 47.91. We could pull back as far as here and still be technically bullish and in a technical uptrend and look for buy side support to go ahead and break all-time highs. It does get grim if we do go below. However, just pointing out that on a longer term basis, we are extremely bullish and we remain bullish above the 47.91 area. But again, looking at today's candle, red body candle, a win to the bears. And again, it was a very huge digestion day. I think it makes more sense if we hop on the 5-minute chart first. So this is where we opened on the day, right? We opened right here. Bears took us lower. We had this digestion chop. And then when we broke this key level right here, we came down, broke it right here. We absolutely dumped on pretty strong volume and we found bullish demand right here. Bulls did come in a strong way and took us all the way back up to this line right here, the 51.66 line. And I think tomorrow that's going to be an absolute key line. I think if we're below it, we probably find lower price action. If we're above it, maybe we'll go ahead and test these new highs. But looking at the daily chart, now that we have context, we can actually see that a lot of the buying we saw, a lot of this wick buying was towards the end of the day. That's something you don't really want to see. That indicates a lot of weak buyers in the market. And if we do get below this wick, a lot of those buyers could exit their positions very quickly. That being said, we're still above yesterday's open, still above yesterday's lows, well above the week lows. And this equal low right here is probably the line we want to look at for the rest of the week. There's only 2 more trading days left. So unless bears make a real strong stand with conviction, which we haven't seen in the last 3 months, I doubt we probably get to these levels right here. It could happen for sure, but it's very likely that we'll probably go test yesterday's open more than anything else. All in all, we look at this chart and this still remains critically bullish, making higher lows, higher highs, and closing the day at 51.66. Again, just a digestion day. There was nothing more you can say about it. Not much happening on the macro front, the fundamental front, especially with most of S&P 500 earnings behind us now. Now guys, let's look at earnings. Today we're going to look at Dollar Tree and a pretty good barometer for the lower income quartile consumer. Now Dollar Tree, guys, the market did not like this earnings at all because they reported a diluted loss per share of $7.85. They said they were closing 600 600 to 1,000 stores. They were down 14%. The market didn't like this. When you see an earnings gap down like this and it stays at this level, it means a lot of that news wasn't priced in, and now the market's gonna spend the better part of the next week, 2, 3, or maybe 4 weeks price discovery to see where is fair value for the stock right now. And as I see it, this is not a name you want to be in. I think we're gonna actually go ahead, keep an eye on Dollar General's earnings tomorrow to see if this is a sector specific thing in terms of the dollar stores, or if this is an exclusive problem just to Dollar Tree. So just a bit of weakness here at the lower income quartile of the consumer. Now looking at the fear and greed index, as some of the bigger names have pulled back, we've moved out of extreme greed into greed. So the market's still fairly bullish. However, some of that exuberance is starting to dissipate. And that's kind of what you want to see. We did run up very, very far, very, very quickly. And now we're starting to see this correction. In some names, it's a correction in price. In others, it's going to be a correction in time. All in all, what we are starting to see is actually healthy for the market. We have some very interesting stats right here. So this is S&P 500 when we have an up January and February and the subsequent returns. But something else that's added that's very, very interesting is we got a couple of different metrics for when these rallies did occur. So we got PE ratio normalized on the 5-year EPS. We got the yield curve, changes in M2, and then we got investor sentiment right here. Now, when we've had an up January, February, these are the returns we can expect on average: 1.4% return in March, 12.2% for the rest of the year, and then the next 12 months, we can expect a 14% return in the S&P 500. Now, this actually normally occurs when we've had an average PE of 18 and the yield curve wasn't inverted. Currently, we have a PE ratio of 29.4, again, 5-year normalized EPS. Yield curve is currently inverted and the change in M2 has been negative. So we're in a tightening cycle compared to what normally happens in history, where we've had fairly low PEs compared to what we have now. The yield curve is uninverted and there's actually been a positive change in the M2. So what this does suggest is that future returns might not look like this, and it actually might look significantly less or potentially negative if we do get like PE compression. However, this is skewed because of a couple of reasons. Technology, comm services, and discretionary really skew PE ratios just because of the big tech firms and technology firms. And we do know that because technology now is the biggest sector in the United States. And the technology sector is about the same size the energy sector was at the beginning of the 1950s relative to total market size. But if we actually have a look at it based on history, the information technology sector is about half the size it was of the transport sector and about a quarter the size of the finance and real estate sector. Now, this goes back to the 1800s, but it's still good data to draw on. And the reason why tech and comm services command such a high PE is because it's literally global innovation. This is where the market is going. In the 1800s, the market was trending towards real estate and finance. In 1850 to 1900s, it was transport. Cars were being made, planes were being made, that sort of thing. In 1925, when we discovered oil and we moved away from whaling and stopped using whale oil and baleen for lighting and heating, and we started using oil refined from the ground. This was the biggest sector, right? And now it's technology, and this is how the market moves. And if you actually go ahead and look at the equal weight, we're trading at about a 16, maybe 16.5 times PE. On a forward basis, the current S&P 500 is 20, and then on a 5-year normalized PE, it's trading at 29x. So yes, PEs are elevated, but the whole market isn't quite as elevated as it might seem. But the data that I showed you can be looked at many ways because the backdrop does show high valuations. We're in a tight monetary policy regime, but the devil is in the details. Now, guys, let's actually talk about CPI. This is some interesting data. This is data from Fundstrat. 4 ways you can react to the CPI. Now, we got soft, we got cool data, hot data, and the S&P 500 5-day reaction. So let's say we get soft news. We're up 3 to 5%. That's actually good news equals good. By the rip, there's gas in the tank. The same thing for hot. We get hot data, we're up 3 to 5%. Bad news is priced in. By the rip, keep going higher. Now, if we get hot data right and we go down 3 to 5%, this is normally the base case. By the rip, there's gas in the tank. Only time it's bad is if stocks go down on good news. And that could be when we get a top signal in the first half of 2024 or whenever that happens for the most part. You can use this, as far into the future as you would like. It's a really good game plan for taking trades in CPI. Now, looking at the market's reaction to CPI, CPI. February CPI only reduced Fed fund rate cut market pricing by 5 basis points. Market pricing subtracted a full rate cut, 25 basis points, from the 2024 Fed cut expectations following the January CPI report, but only 5 basis points following yesterday's CPI report. Even though we did get a headline hot number, the market didn't react quite as heavily and stocks did rally for the most part. That being said, rate cut expectations did fall 5 basis points for the rest of 2024. And looking at inflation swaps, inflation, 2-year US inflation swap ticked up ever so slightly. We were at 2.39%, we're now at 2.43%. And despite the hot headline CPI numbers, overall inflation expectations as well as rate cut expectations for 2024 haven't changed in any substantial way. We're still eyeing a rate cut in the middle of 2024, around May, June, July, somewhere around then. Now let's talk earnings, guys. We do know that we are in an earnings driven rally. Earnings is absolutely coming in double digits. For Q4 2023, we're looking at about 10% earnings growth, excluding energy. We're looking at about 13.4%. Great earnings when you look at it. And we do know that for the rest of 2024, we are expecting blockbuster earnings, especially in the second half of 2024 into 2025. And we can actually see here, this is S&P 500 earnings revisions. Now, excluding recession years, estimates have historically held up. This is S&P 500 historical financial year 2 EPS revisions versus 2024-25 consensus. Now, this is where we are right now. We can see that earnings revisions are ticking up. And according to the data right here, the revisions we're seeing, these upward revisions, should hold up throughout 2024, even into 2025, the first quarter. BofA does actually expect an increase right here. That's the expectation for the end of 2024. So we should actually see earnings tick up. And for 2025, revisions are actually moving upward. Very, very good sign to see 2024 earnings moving up, 2025 earnings moving up. That being said, the historical average is this. And if we do sort of go down, it shouldn't be a surprise to anybody. And we should expect market volatility if that happens. Now, earnings typically recover stronger than they fall. The reason why we're rallying is because even though earnings does fall, guys, the market is super dynamic and we normally par those losses 10 months later, 12 months later, earnings recover significantly. So yes, we fall, but normally they recover in excess of their previous declines. Now let's switch gears and talk about capital expenditure. I do think along with the strong consumer and higher wage growth, capital expenditure is one of the reasons why we're seeing better than expected earnings. This is S&P 500 CapEx guidance ratio. And I do think we're at the beginning stages of a huge CapEx cycle because a lot of the equipment we're using now is pre-COVID. It's getting a bit old and we do need an upgrade cycle in the form of pretty much everything. And S&P 500 firms have realized this, and this is why we're starting to see higher guidance for CapEx. This is the average guidance ratio. That is what companies normally guide for. The 1-month guidance ratio is all the way up here at the 2 level, and the 3-month guidance ratio is just below the 1-month guidance ratio. So it does look like we're entering a CapEx cycle, and we are actually starting to see this. We know that Meta, Google, Apple are spending a huge amount of money on CapEx, especially to service their AI needs. We also know that tech investments have accelerated since COVID. Annualized growth in BEA private fixed investments on info processing equipment and software. We're looking at a 10% growth year for the AI cycle, which is significantly higher tech investment than almost any other time in history other than the 2000 tech bubble, because companies are realizing what AI can be, the productivity it'll bring, and I think they are going to invest in that. Now, hyperscalers are expected to drive most of CapEx growth for the S&P 500 in 2024. Now, S&P 500 hyperscalers include Meta, Amazon, Google, and they got Meta here again, but I think this is actually supposed to be Microsoft and their CapEx. Now, we could see in 2024, it's expected to grow 27% on a year-over-year basis to $179 billion. And then ex-hyperscalers, they're also investing $825 billion, and that's going to be a 1% year-over-year change, but still a huge spend for the year in total. So CapEx spend is going to drive earnings growth as well as a resilient consumer like we spoke in yesterday's video, and the fact that rates are going to come down. All of this is contributing to huge earnings growth in 2024, 2025. And that's why the market is absolutely rallying. It's an earnings driven rally, but also a projected earnings driven rally. Now let's switch gears, guys, talk about Bitcoin. This is very, very interesting stats right here for those of you that are trading Bitcoin. It just talks about Bitcoin's correlation to stocks and how you can use Bitcoin as a hedge. And long story short, Bitcoin isn't a great hedge because it doesn't hold hold up well during periods of market stress. It actually declines a lot more than stocks usually do. So when stocks are down, Bitcoin goes down. When stocks are up, Bitcoin goes up. The only difference here is that in normal times, Bitcoin outperforms equities. So in a downturn, Bitcoin and stocks are very, very correlated, but in really, really good times, Bitcoin outperforms equities. Now let's talk seasonality. Now this is the S&P 500 seasonal composite cycle, guys. This is where we sit currently. This is the March cycle, and this is where we are right now. So we're really pulling forward a lot of March's gains. It's been a lot of volatility. However, as you can see, we've made a high, made a low, made a higher high, made a higher low, and we've gone ahead and made a higher high for March. And normally that's actually what we do in March. Look at the average cycle here. This is what we do. We go high, low, and then we keep going. So do expect this to continue. Do expect to pull back somewhere here and then continue higher. And that's what normally happens in the March composite cycle. Now let's talk gamma. Now looking at gamma, guys, not really much to add. We see continued consolidation of the 5200 strike. Negative gamma keeps getting removed as we do just grind up higher. You can see we're now at the 5175 level in the S&P 500, slightly below that at the moment. This was the open price. But yeah, we were at about 5,000 at the start of the week, and that's just the thing. In a positive gamma environment, we buy dips, sell rips, grind all the way higher to the core gamma resistance. And if we were in negative gamma, we do the same to the negative gamma strike. What we are seeing is that the strike is now insanely built up. There's about $2.3 billion worth of hedging activities that need to be done at this level. It's going to keep price pinned. I don't think we're going to go over it by OPEX. We really need options expiry to remove a ton of this monthly gamma right here. Once this is removed, we can then see which way the core gamma strike moves. And that's the major thing we have to watch over the next 2 days. Where does the gamma strike reposition itself after OPEX? That's going to be extremely, extremely key. As it stands right now, it's looking like the 5250 area, but anything can happen in OPEX. We could have a ton of gamma wiped up all on the top right here, and then the gamma strike moves down, then the gamma flip zone moves up. So over the next 2 days, since we are at 5200, the key thing is to watch where the gamma strike repositions itself, and that's going to tell us what direction we're going to move. Is it going to stay here and we're going to chop? Is it going to move up? We likely go higher. Is it going to move down? Then we are going to see a correction in price as well as time. Looking at market breadth, this is just percentage of stocks at 10-day, 20, 3-month, 6-month, 12-month highs, and you can see there is a ton of green in the charts, and this is exactly what you want to see. This means a ton of stocks in a ton of sectors are at highs, pretty much highs. That's exactly what you want to see. Compared to the lows, very few amount of stocks are actually at their lows. There are outliers, but if you actually look at the entire sectors as a whole, very few stocks at 10-day lows, but particularly 252-day lows. It's like 1% of stocks in healthcare, 2% of stocks in utilities, 1% of stocks in the entire S&P 1500. Now, this is the core market model. Essentially, it tells us if we're overbought or oversold. Generally speaking, if you are above this zero line right here, you want to hold strong and remain bullish. At extreme overbought, you want to hold. If we get below the zero line, that's when you want to look at maybe taking some chips off the table. And this right here is strong leadership. And that's exactly what you want to see. And generally speaking, when we do get into these periods of overbought, we can see a bit of a pullback. But generally speaking, when we enter, we do stay in these periods for extended periods of time. We're looking at 18, 12 months, and we just grind higher. Yeah, we can have near-term weakness, but generally the trend is up. Now, looking at the bellwether stock index, sort of like a barometer for the economy, it just looks at all of these stocks, and it has stuff like Apple, Amazon, Boeing, FedEx, JP Morgan. So a good range of all of the sectors, and we're at all-time highs. We pushed above this key resistance, and this is extremely, extremely bullish, and it's a good barometer for the economy. I do know that the market as a whole can be skewed by tech, but when you have an equal weight index like this with all of these names, what you could say is that the economy as a whole is doing really, really well. Now, looking at the S&P 500, sectors above their 50-day moving average, 100% of sectors are above their 50 moving day. That includes utilities, that includes energy, all of those sectors. Looking at sectors above their 200-day moving average, the exact same thing. 100% of sectors are above their 200-day moving average. And this right here, that is extremely, extremely bullish. 200 moving day average is sort of used as the golden child of, are we in a bull market? Are we in a bear market? Should we be long? Should we be short? And 100% of sectors above the 200-day moving average shows the bullish conviction in this market. Now, continuing with some breadth metrics right here, percentage of stocks within 2% of 52-week highs, 5% of 52-week highs, and 10% of 52-week highs there's a lot of stocks within their 52-week highs compared to when we hit the lows right here, when like less than 10% of stocks were within 2% of the 52-week highs. Same with 5, same with 10. Compared to where we are right now, you can definitely see the trend is up and actually moving up, especially from this October low here. And that's exactly what you want to see. Now, this is the percentage of stocks above their 200-day moving average right here, and then the number of days above 80%. Normally, when we do get above 80%, like we did right here, here, and here, we actually stay in this period of overbought for a very long time. Normally like 69 days, 91, 135, 98 days, and normally the average is about 80 days. And this is where we are right now. We're sitting at 79.48. Once we tick above this 80 region, we're going to start counting the days. And normally we could go periods of 3, 6, upward of nearly 12 months above the 80% region here of percentage of stocks above their 200-day moving average. And that means we just grind up. We have minimal pullbacks and we just kind of just do this grinding motion all the way up until we have a major macro event or something big happens, like the GFC crash, like the .com crash, or like the COVID crash. Some huge extenuating circumstance really needs to take us off course significantly. Now, this right here is consumer sentiment, University of Michigan. And this is when consumers feel pessimistic about the economy below this red line, above the green, they feel good. And we're actually starting to get above this 80 region here. And normally when we get above this line right here, we see an inflow into the economy, more consumer spending, consumers feeling better about the economy because they're making more money, cost of living is coming down, that sort of thing. And this is what you want to see in a bull market. And normally when we do get above this line, we actually normally trend for long periods of time, literally from like 2012, 2013, all the way to 2020. This was years of us feeling very good about the economy. And same is true right here. Same is true right here. Now, looking at the New York Stock Exchange Composite, new highs versus new lows, and breadth is continuing to expand. More stocks are making new highs, and this is the highest level ever since 2021. And look, in a vicious bull market, you can get readings super high like we did here in early 2021. And this might actually only be the start. Now, looking at the risk on, risk off indicator, this is short term, medium term, and long term risk off indicators. Now we can see here the short term is quite volatile. We're not going to talk about this. But the medium term risk profile is sort of ticking, is at this inflection point between risk on, risk off. And we can see that's the reason why we sort of had this downward momentum in the longer term risk on, risk off indicator. That being said, we are still in risk off territory. We are still incredibly high, and it is still a risk on environment in the long term, but we can see near term volatility. Data, guys, the big points of contention is going to be retail sales. That's coming out tomorrow. And then we have PPI after that. Now, looking at retail sales, BofA expects retail sales to come in really soft, really cool. Bloomberg expect retail sales to come in at the consensus numbers. One thing I will note is that in yesterday's video, I showed you MasterCard Spending Pulse survey. Sales for the year-over-year figures were actually in double-digit territories for certain things. Go and watch yesterday's video and you'll be able to see that. So I do think we're probably going to hit the Bloomberg consensus here versus the BofA forecast. That being said, it doesn't matter which ones we hit because we react, we don't predict to the market. But if you've made it up until here, thank you so much for watching, guys. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.